This is you, but you are sad. Sad because you live in a time before planes, before cars, before even money. And everything you need or want you have to swap or barter for. Cows for chickens, chickens for wheat, wheat for shoes. But in this modern world, money is the very lifeblood of our daily existence. It allows for the exchange of goods and services with a lot less friction. And for this system to work at scale, across businesses, countries and globally, we need the financial markets. But how does it all work? And what even makes it move? Well, it's actually quite simple. Let's imagine a company called RobbingHood AI. They sell cutting-edge AI trading bots that do absolutely nothing, except flash green lights and say,
buy the dip.
And somehow it's taken off. Finance TikTok is obsessed. But the RobbingHood CEO wants more money. And they've got plans for version 2.0, a premium model that flashes twice as fast and plays lo-fi beats to simulate that feeling of financial competence. But this kind of tech costs money, and to fund it, they need to raise capital. So they decide to go public, meaning they list themselves on the stock exchange through something called an initial public offering, or IPO. And once listed on the stock market, in exchange for cold hard cash, investors get a slice of ownership and the chance to benefit if the company grows. In simple terms, companies sell shares for money, investors buy for number go up. But what actually determines that price? What makes it go up and down? Well, financial markets are often described as a two-way auction, and we all know how a standard auction works. You have something for sale and buyers bid the price higher. The price moves in one direction, up. However, the two-way auction works slightly differently. Rather than just buyers bidding, we also have sellers asking. But in order to match these buyers with sellers, their orders get placed on what's called an order book. Think of it like a giant waiting list, where all the buy and sell offers line up, organised by price, waiting to be filled. These orders are called limit orders. They are resting, lazy, because on their own, they don't make the markets move. For that we need John here, and John has heard all about RobbingHood AI and wants to buy 10 shares now. So rather than putting in a limit order, John places a market order which will buy at the best available price. 3 at 101, 5 at 102, there are no sellers at 103 so that gets skipped, 1 at 104 and so on, until he has all 10 shares for an average price of 102.30. Now you can see that the price of RobbingHood has gone up to 106, and this is because the listed price of a stock is just the last traded price. And John sees this and thinks, hang on, I bought my shares at 102.30 and if I sell now, I'll make $47. I'm a trading genius. I'm going to be rich! So he hits market sell and, oh dear. John has just discovered liquidity, or at least lack of. Had RobbingHood been highly liquid, he would have bought his 10 shares for 101 and the price wouldn't have really moved. Simply put, price moves because of a mismatch in supply and demand. If there's more demand than supply, price goes up. If there's more supply than demand, price goes down. But all of this doesn't paint the full picture of what the value of a stock is. For that, let's compare the price of RobbingHood AI against Banana. At first glance, you might think that RobbingHood as a company is more valuable than Banana because bigger is better, right? But not all companies have the same number of shares. RobbingHood has 1,000 shares, whereas Banana has 100,000 shares. So when you add the price of all the shares together, you can see that Banana has a much higher theoretical value, otherwise known as market cap. I say theoretical because liquidity. If everybody wanted to sell their shares all at the same time, supply would outstrip demand and market cap and price would go down very quickly. So there we have it. Companies sell shares to raise cash. Markets trade in giant two-way auctions. Limit orders wait, market orders don't. Price changes when supply and demand are not equal. Liquidity decides how much price moves. Market cap shows what it's all worth in theory. Told you it was simple. That's odd. Not again! Oh, like and subscribe! Oh, leave a comment! Oh, please!